Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May, and this is Long Verticals and Diagonals. And today we're going to be talking about that moment when a trader really thinks they know exactly how an options trade is going to play out. We're right near expiration. We're pushing it right to the edge, and then the unexpected happens. We actually have an example trade in our paper money portfolio that has a lesson contained within it that I think is important. So we're going to be looking at that. We're also going to be adding a new trade to our paper money portfolio. Lots to cover. Before we get to any of that, though, let me first of all say hello to everybody that's chatting in out there in YouTube. I already see a lot of familiar names out there. It's great to see everybody. Good to see Dragon Rider and Scott, Life in the Fast Lane, Tatiana, Rick, JB52, Josh, Kevin, TD, William, and everybody else. Thanks for joining us week after week. I really do always appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the presentation has been concluded and posted to our YouTube channel, enjoy the show, but be aware that you're invited to join us in the live presentation if you'd like to be here. This is a Thursday webcast series, and we kick things off promptly at 11 Eastern. If you'd like to be here in the live audience, we'd love to have you. Now, I also want to let everybody know that my very good friend Connie Hill is going to be hanging out in the chats with us. Connie's there to help us address any questions. If I can't get to those just while I'm talking during the flow of the presentation, Connie's going to be picking up the slack for me, as long as those questions are not too far off topic. Connie's there to help out. So thanks for being there, Connie. And Connie and I would also like to issue an invitation to everyone watching. If you have an account with X or on X, give us a follow. You should be following your favorite presenters on X. It's the best place to connect with your presenters in between these live streams. So you can find Connie there at Connie Hill CS. You can find me on X at Cameron May CS. But let's get into this discussion. It's about learning lessons from practice trades. Yes, it can certainly apply to real trades, but there is an important lesson here. Let's first of all talk about the risks associated with what we're doing. So as we go to these disclosures, they are important information, so please bear this information in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. Okay. So let's set the agenda for the day, and it pretty much mirrors what we typically do in this webcast series. We have a portfolio of example trades consisting of long verticals and diagonal spreads, and it needs our attention. We're going to go see how some of those trades are progressing and how one of those has this quite important lesson contained within it for the way it's behaved just over the last 24 hours. Very new information, but we're going to look at our example positions, see if there's something that needs to be done, and I think we are going to be making a change to the one that I'm referring to. And then we're going to go have a look at the markets, see what's going on there, and finally, plan and place a new example trade for our paper money portfolio. So it should be a lot of learning. Let's go right to the thinkorswim desktop trading software platform and look at our 4 current example positions. So right now we have Amazon, we have Gilead, we have Lowe's, and we have United Health. Let's have a look at Amazon first. It is going to be United Health. Don't look at a chart. You're going to spoil it. But it is going to be United Health that has that lesson for us today. But with Amazon, we have a long call vertical spread. So what we've done here, bought the 185 calls, sold the 190 calls. The preference here, this is a bullish strategy. We prefer to be up above $190 as we get toward the 16th of May. Well, we're not up above $190. As a matter of fact, we're below our vertical spread right now at 173. So if we look at that on a chart, here's our trade. Bought the 185 long calls, sold the 190 calls. We'd prefer to be up above this red line, up in this green zone. That's our maximum theoretical gain area. Where we don't want to be is down here as we get toward that expiration. In this case, both of these contracts are now out of the money. There's not much risk of assignment on the short calls up here, although saying risk of something happening is always sort of in the eye of the beholder, because in this case, the objective of the trade is probably to get a sign on those shorts so we can exercise our long and realize the gain on the trade. So it's just not likely to happen right now with the way the stock is behaving. We entered the trade back here on the 27th of March. This thing started misbehaving right away, fell. Now, for some traders, they may have decided just on the evidence of this fall below support, time to get out. I like to leave trades on a little bit longer, learn through the duration of the trade. But in this case, we rallied back up to that broken support. It acted as resistance. We've come back down again. There's still some time on this trade, 29 days left till this May 16th expiration. We're going to see if we can get a recovery. It's just that this has now turned from a low probability trade, pardon me, a high probability trade into a low probability scenario, because we've got some work to do to get back up there above 190. We'll see. Now, if we want to get a gauge for what is the likelihood that we ever see 190 again before expiration, what could we check? Well, we could go to our trade tab, go to our expiration, the 16th of May, and just make sure that we have, let's borrow one of these columns here. I'm going to switch this to our option theoreticals and Greeks and go to the probability of touching. This is literally the mathematical probability that price touches the $190 level before expiration. And that's about, if we look at this, about a 60% probability. So with us all the way down there at 173, there's still a better than not chance that we get back up where we need to be. It doesn't mean that we'll stay there, but there's a strong probability that we at least touch it, and then there could be an opportunity for an improved exit over what we're seeing right now. Whether that's actually maximum theoretical gain or just a smaller loss, or maybe a bit of a gain but not max theoretical gain, we'll see. But that can be a powerful tool for giving some context for, now actually, oops, I looked at the wrong one. Did I look at the wrong one? I certainly did. I looked at the 185. It's only 44%, 45%. But in any case, let's leave on that Amazon trade. Let's go have a look at what's going on with Gilead. With this one, we bought the $95 calls for the 17th of June of 2027, 791 days. This is a long call diagonal spread. So with this, we have the preference for the stock to rise as far above 95 as possible, while staying below our short calls at 110. Now this one has a bit of a history. So let's go revisit history. Let's look at Gilead. So we bought that long call back here. The stock has been up, the stock has been down. It's higher than the time when we entered. So our long calls, to go back to our monitor tab, bought those for 16 bucks. They're now worth $24. Long calls are actually doing pretty good. Now along the way though, we've sold some short calls. A couple of times we had to take some losses. A couple of times we took some relatively smaller profits. So the combined, it's a net cost of doing those short calls, if we recognize the losses minus the profits. So we're underwater on the short calls. We're doing okay on that long call. And that brings us to where we are right now, where we've most recently sold the 110 short call right here. So the preference is continued recovery on stock price, but to stay below 110 as we hit that May 16th expiration. That's going okay. We're going to leave that one alone. But net overall on the current position, that's between the long and the current short, up $2,500-ish. Now here is our lows position. There should be, without even looking at the position, we don't know what this trade is, but there's something here on this screen that should at least get the trader, I don't know if it's excited or anxious or intrigued or what. What do you see here? And the hint is in the icon area. What's going on with lows? This trade is currently in the money, and that can sound spooky, but actually in the money is the designed outcome for some trades. This happens to be one of those. This is right now profitable. These are unrealized gains, just like these are unrealized losses. Unrealized gains of $1,625, but this is a long put vertical. In this case, we bought the 240 puts, sold the 230 puts, the preference for the trader here is for our stock to be below our vertical spread, and that's right where it is. It's actually down at 218, about 12 bucks in the money, which, yeah, elevates the risk of assignment on the short, but in this case, that's actually the desired outcome, most likely for our trader, because we have the right to sell shares at 240 if we exercise that right. We have an obligation to buy shares at 230 if that obligation is assigned. So is that a positive or negative outcome if we buy shares at 230 and sell at 240? If we get assignment and we exercise, that'd be a $10 profit on the stock transaction, but this trade did cost some money to set up. It cost us $7.20 between the two contracts. So right now we're sitting on a scenario where we've turned $7.20 into an unrealized gain of about 10 bucks. So this one, we're going to leave this alone. Now notice the number of days till expiration. Tomorrow is a market holiday, no trading tomorrow. These contracts actually assigned close, they expire close of business today. So this is a rare opportunity where on a Thursday, we get to talk about our contracts are just about to expire today, right where we want them to be. And so this is going to lean us into this lesson that I wanted to talk about today. UNH is really going to teach us the lesson. It's going to put a big exclamation point on it. But with this $12, ooh, look at that. It's only $11.50 below where we need it to be at close of business today. We might be feeling quite confident. Let's look at a chart. Our trader here, let's assume, let's make this real. Let's just say that our trader is quite confident. Here's our long put, here's our short put. We're way down here and expiration is just right around the corner. It's literally hours away. Surely this is going to be, both contracts are going to expire in the money. Surely both contracts are going to be assigned, right? Not necessarily. The unexpected can and sometimes does happen. Is it possible that that there is a rally before the close of business today, and then we get up above 230, and that we're no longer in max gain territory? Is it possible that there's a strong enough rally, something comes out and drives price up to 240? It's possible. It's just not very likely. Again, we could come to our trade tab and look at the probability of touching for today. Here are our positions. And if we go over here, there are our positions. Probability of touching, comparatively remote, it's still a possibility if we get a big move. Okay? All right, but we are going to leave those on. Let's see if we can just get those assigned and get our contracts exercised. If you haven't ever held contracts to expiration, or if you're just wondering, what happens at expiration, all in the money contracts are automatically exercised on behalf of the owner, unless that owner takes the steps to contact their firm and say, do not exercise. It doesn't happen very often. So if we're below 230, yeah, the short should be assigned. It's not guaranteed. There are rare exceptions. And our 240, unless we left notice to not exercise it, it'll be exercised, and we wind up buying the shares at 240, selling those at 230. So I'm going to leave those alone. But I just wanted to make the point that even though we feel like there's no chance this could reverse in the next few hours, yes, there's always a chance. And UNH is our example. So with UNH, we bought some 520 calls. Bill's saying, could we just close it? Yeah, we could, Bill. Yep. Some traders might choose not to. At this point, we're probably at maximum theoretical gain. What would be the conceptual advantage of not closing it? Well, if we're anywhere short of maximum gain, maybe we can realize that full potential of the trade by not closing right now. What is the risk of not closing it? Well, risk is still present until the closing bell sounds, and even for 15 minutes after, if the price is still moving, this thing could gap up on maybe some unforeseen news. So yeah, in this case, I'm going to if it makes us uncomfortable, that's okay. I like my audience to feel the discomfort of difficult decisions. Yep. Yeah, no, the NODAC says you get to sleep better too. Yeah. Yeah, I'm not planning on taking a nap before 4:15 Eastern. But let's go to this United Health, because this one is going to, if we weren't awake, this is going to be a jolt of caffeine here. But this is a trade we actually started back on January 9th, and we just decided we're going to buy a long call and hold it all year long. So I'm not going to close this out. That's a decision that's already been made. But along the way, we're going to be selling short calls against this long position. So that's where we find ourselves right now. We bought the 520 call, 638 days till expiration, and we sold. Right now, we're in the 530 17th of April position. That's today. This one expires today. And I'll tell you, yesterday, this thing was way in the money. Today, it's way out of the money. Here's what's happened overnight. Put yourself in the shoes of the trader who owned this. Here's our long call. Up until yesterday, it actually was doing pretty well. It had a lot of additional value over what we paid for it. But we had this short call. We decided to hold on to it last week to see if we could get a lesson. And that lesson has now delivered itself. That's what I wanted to talk about. This is exactly the sort of scenario where a trader might feel totally comfortable that they know precisely what's going to happen at expiration. Dragon Rider says, ouch. Yep. For the long call, that's a big owie. For the short call, if we were looking to avoid assignment, we're probably going to avoid assignment here. Now, this is a paper money account. There's never a threat of early assignment in paper money. There can be a threat, especially when something's gone so far in the money like this had before assignment, before expiration. Even an out-of-the-money contract can be assigned. It's just that risk of early assignment goes up the deeper we get in the money and the closer we get to expiration. So I'll bet we're not alone in the group of traders that were thinking yesterday, well, yeah, there's even an earnings announcement tomorrow, but this thing is definitely getting assigned, right? We closed trading at $585 yesterday. Earnings came out, apparently, I haven't seen what the news was. I can probably guess what the news was. I would guess it was disappointing to some degree because we got this. Overnight reaction and a continuation of selling during the normal market hours. And we have fallen $130 and gone from $585, which was $55 in the money, and now we're down at $455, and this thing is now on the 530 contracts. This is now $75 out of the money. Assignment risk has been dramatically reduced. Still present, it's just getting remote. Noor says, does UNH chart still look good for a poor man's covered call? And that's what some people call this. A long call diagonal spread is sometimes referred to as a poor man's covered call. I've actually referred to that in previous webcasts, although I would say let's modernize the language and call it the poor trader's covered call. But Noor says, how might we decide when to do a new trade? Yeah, do you think that some traders might admit defeat at this point? Say, well, I thought the stock was going to go up when I bought this long call. We've broken down. Maybe it's time to get out and lick our wounds and just say, well, we didn't make money on this one, on our long call. That's a possibility. I'm not going to do it because I said on January 1st, we're just going to do an experiment, trade the same call all the way through a year and see what happens. So we're going to continue that experiment. But for some, yeah, an event like this or a break of support, they might decide, pull the plug. In any case, this short call, we're going to wrap this one up. Is it worth anything at this point? A penny. Might cost us a penny or two to get out of this. We'll see. So we sold that for $530. Let's close that out and let's see if we can roll this down. Now, one common assumption among technicians is that when we get a big gap down, the top side of that gap, that would be, pardon me, the bottom side of that gap in a gap down, but the top side of the gap candle may act as a resistance area. That looks like that's right around 490. What was today's high? Yeah, 489.79, within pennies of 490. I wonder if we can close this call for pennies. What could we get for like a 490 call with all of the remaining volatility? We'll see. There's probably been a collapse in volatility on that. Let's go have a look at the trade tab. I'm going to go out another month. Let's go to the 16th of May and look at that 490 call. All right, that's still trading around $7, about 1.5% of the current price of the stock. I'm gonna roll to that 490 16th of May contract. Now, rolling just means we're going to get out of one contract and then use the same order ticket to get into a new contract. Just be aware that multiple transactions like that can increase the number of transaction charges, the commissions. Yep, that's what we're going to do. So let's go to our monitor tab. I'm going to right click on the short call, the 530 call. Let's create a rolling order, and it'll say calendar. That's because that's what a long call and a short call at different expirations are. But really what this is in order to buy back the 530 call that we are in, and we're going to sell, let's move this out to the 16th of May, 490 calls. This is not going to be done. Well, actually, sorry. No, I'm just going to not finish that sentence because it was wrong. Anyway, yeah, it looks like net credit between those two. Let's say we're able to get, let's see if we can get $7 credit. Closing out of the one, selling the new one. Even though we've moved more toward the natural, it's not a guarantee that this order will fill, but we'll see. Let's click confirm and send. And we're going to sell this now diagonal, just trying to get a $700 credit on this roll. And let's send that order off. Now there is a commission on this, notice. So 65 cents to get out of one, 65 cents to get into another. Send that order off, and let's see where this is trading at the moment. Oh, we're asking for a $7 credit. Man, that mark moved on us. Oh, we might be asking a little bit too much at this point. So I'm going to do this. Let's right click here. Let's cancel and replace this order. Yeah, look at that. Boy, it might only be a 650. Things are moving. When a stock is dropping this quickly, let's quickly change this to a 650 credit. Still a commission to be paid here. Let's send that off and see if we can get that filled. But while that's working, okay, I think that one looks like it has a little bit stronger chance. There can be a pretty good spread between bid and ask prices when contracts are moving like this. So that can make it a little bit less liquid. It can make it, or a lot bit less liquid. We'll see if we can get filled. Let me see if I missed any questions here. So CT says, what kind of risk control is used on these positions? Well, so with each of these positions, there's a defined risk in them because they have a fixed cost. So that cost becomes our maximum theoretical loss. I don't make changes to these positions in between these webcasts. I like to talk through the pros and the cons of each exit that's selected. Sometimes, though, we will add, like, let's say, a stop CT, but that would be just to sort of illustrate how a stop might be done or the logic of a stop, different ways that it might be placed using stock price or using the contract values. But on the current positions that we have, the trader might just need to be comfortable with the potential for losing the whole value of the trade. Not everybody's comfortable with that. So in that place, they might implement something like a stop. But this thing, oh, it is walking away from us. We're not getting filled. All right, well, sometimes in the interest of getting a fill, I have to get a little bit more aggressive. Let's say we're willing to say that we'll settle for even a $6 credit. Why is this credit running away from us? Well, these calls are becoming less valuable as the stock price falls. That's what's going on. So let's change this to a $6 credit, confirm, and send this off. Still a 130 commission. Noor says the strike price for May call is actually less than our actual cost of UNH call. That's a possibility. Yep. We'll see if that, let's see. Yeah, we have, in other words, you're talking about, Noor, that we have a 490 strike against a 520 long call, right? Yep. And we could, let's see if that may not, we'll see if that gets filled. Yep. All right. In any case, I'm going to let that continue to work. But the lesson here, what I might even do here, you know what? I'm going to cancel this order entirely because, Noor, I want to give your question a little bit more treatment. Maybe we'll talk about that next week. I don't want to dedicate time to that today, but it's a very solid point. Selling a short call below the long call strike, that's kind of weird. Yeah, we want to talk through that. So how about we make that an agenda item for next week? But we're just going to cancel this roll. It's being a little bit sticky, and I want to move on with this discussion. But what that's going to leave us with is just a long call position. So for the next week, this is not going to be, actually, let's do this. It's not going to leave us with that because I do want to close out that short call. Let's create a closing order. Let's close that out. Let's say, we might even be willing to spend 5 cents to get out of this. Let's just try to increase the likelihood of a quick fill. Let's click confirm and send. Offering to buy that call back for 5 cents. It might only cost a penny. We'll see. There is a commission to be paid. Let's send that off. But the objective here is just to leave us with a long call. So if we get a recovery, sometimes can there be a huge snapback event after a sell-off of $130? That's a possibility. And if there is, then our long call isn't hindered or slowed in any way by the presence of a short call. Now, trade-off there is there's also not much, there's nothing to hedge the downside to any extent. Not that a short call is traditionally a hedge, but it's being, and this is not uncommon with a call that's gone this far out of the money. The spread between the bid and the ask can get very wide, and it can make it harder to fill these orders. All right. But in any case, we're going to leave that there. I do think that was an important lesson, an interesting discussion to have. Just when a trader feels entirely confident, this thing's $55 in the money, I know what I'm confronting here. It's going to be assignment, right? Nope. All right, so let's go to the markets and let's plan and place a new trade. And as I do that, let me just have a quick look, see if I missed any other chats here. Josh says, on the Lowe's example reviewed, why wouldn't the trader purchase the 230 put signed shares to us with the price at 218? We're covered. Josh, they can assign early. It's just that most traders do not assign early. Just because a contract has gone in the money, most of the time it's mathematically in the owner's best interest. So that short put that we sold, that owner, it's usually in their best interest rather than assign, or in other words, exercise their right. It's usually better to maybe sell that contract to someone else. That creates a larger gain than assigning the contract. Okay. Anyway, let's go have a look at the S&P 500. Let's see what's going on. It was showing some weakness earlier today. Here are some things that we've been following over the last couple of weeks. Number one, yeah, it's been a rough last couple of months. We've sold off, come up to a peak, sold off. We've been seeing maybe lower highs and lower lows. Interestingly, the first area of potential support right here was kind of along a diagonally upward trending support line. And we got a couple of touches horizontally there. Maybe gave some technicians some hope that we're seeing a W or a double bottom here. That didn't confirm. We didn't get back up above this high. And then we sold off again down to a new low. Now this low also lines up with, if we go to a longer term chart, previous lows. So it's like we dropped from one ramp, maybe down to the next one. We've seen a rebound off of those levels, but Does that mean that we're going to just continue going higher? I think here's one level that some technicians might be paying close attention to. We've talked about it at least 3 or 4 times in recent weeks. But from this high down to that low, there was a strong ricochet effect, and we bounced up to that 50% retracement line using our Fibonacci's as sort of a convenient benchmark. But yeah, when there's a strong move in one direction or the other, traders, not every trader sees things this way, but for some technicians, a rebound hitting 50% may actually just be a continuation of the trend rather than a rebound going through 50% may signal a reversal of a trend. So we're going to put ourselves in the shoes of a trader who still sees a downward trend to the S&P 500, a bounce up to the 50%, but they're still seeing likelihood that maybe we go down from here. So we're going to be planning a bearish trade. Maybe we're going back down to that trend line. Maybe this just turns out that we start to move higher, but within a lower channel than we were previously trading. Time will tell. We don't know. But let's just put on a bearish trade for our example trade today. And we talk about, in this webcast series, diagonals and vertical spreads. So we have a couple of each already. I think we're going to be adding another bearish vertical spread. So let's go look at a stock that may be representative of the sorts of stocks that a trader looks for when planning these sorts of trades. I'm going to be using, not NVIDIA. We already have a position on that in a different webcast. Let's look at AVGO. What's been going on with Broadcom? Well, Broadcom, much like the rest of the market, has been downtrending, making lower highs and lower lows. Also, much like the rest of the market, it has come up and may be encountering previous support as new resistance. Now, in this case, we're seeing an intersection of a couple of different levels. We have a horizontal resistance that acted as support for a little while, but we've broken back down through that. Might be our new price ceiling again. We've also seen a diagonally ascending area of support, just like the markets, that we've broken. And interestingly, we came right back up to that diagonal level, but maybe that's now a new price ceiling. Now, one other thing, if we're going to be using our Fibonacci's, let's throw a fib on here. And from this peak right there, sold off to a low, what's been the degree of recovery? There seems to be this intersection of horizontal, diagonal, and Fibonacci resistance. Now, you add up all those three. Does that add up to a guarantee that we're going down? No, it's not a guarantee. But let's just say that our trader thinks that at least maybe through the next expiration, in their view, it's more likely than not that we're going to be lower on Broadcom than higher. Now, another thing that we're able to sidestep here is that AVGO has already had their earnings announcement for this quarter. Lots of earnings announcements out there. We're not seeing one until after this May expiration. So we're going to build our trade using this stock. Now, we looked at it through a technical lens. Other traders may have other considerations. Price per share can certainly play a role in deciding whether a trader is going to trade options on a stock or not. Higher price stocks tend to have higher priced options for better or for worse. They also tend to have more strike prices to choose from, but also liquidity can be a big deal. And it typically is. Yeah, for traders, if the stock is illiquid, the options tend to be even less liquid, and there can be issues with their pricing that make them particularly difficult to trade. And we actually just saw some issues with liquidity just trying to get out of the current position, right? But let's go to our trade tab, and let's go to that 16th of May expiration. And how about for today? Let's put on a higher probability vertical spread. Vertical spreads are very flexible. They can be set up with a high probability but a lower reward potential, or they can be set up with lower probability but a higher reward potential. It really just comes down to the trader's preference. With with the long verticals that we trade in this webcast series, going in the money with the vertical actually is sort of like that former scenario that I just described. And in the money, long diagonal of either kind, call or put, is a high probability, lower reward scenario. Going out of the money is a lower probability of success, but a higher reward for being successful. So let's go to, and by the way, I see a series of chats here. Okay, so probability trader is suggesting some other trade. All right. Just be cautious when we say this is how you manage a trade. You won't hear me say that. What I'll discuss is possible ways to manage a trade. There is not a prescribed formula for the most successful way to manage a trade. Obviously, it's going to come down to the strategy selected and the market conditions of the time, and also just how does the trade actually play out. It's never in the traders, or never is a strong word, but it's not really in the trader's control how a trade ultimately plays out. They just do their best, and there we are. Anyway, so let's go for this higher probability scenario, recognizing that we're going to be settling for a lower reward. Let's see, what do we see here on our chart as we plan our trade? Let me get rid of this fib. I'm just going to right click here just to clean things up. And it looks like there's that confluence of technical evidence right about that 185 seems to be a recent price ceiling. I wonder how much we could get as a potential reward if we were to structure our vertical spread to be in position for its maximum gain, as long as the stock is below that 185 as we get to that 16th of May expiration. So let's go look at the 185, maybe the 190, 185 put vertical. So if we look at that 190, 185, this will be our example trade for the day. This is going to be a long put spread. We're going to buy, in this case, the 16th of May 190 put. And that looks like that's trading between 21 and 21 and a half-ish. Let's say it costs us 21.30 to get into that long put. And at the same time, we're going to sell the 185. Let's get the date in there. The 185 put, and that looks like that's trading for maybe 1730 to 1760, splitting the difference about 1755. So what'll be the net cost of this trade? Well, if we're spending 2130 and then collecting 1755, 2130 minus 1755 means this is a net debit of $3.75. Okay? So the cost slash the theoretical maximum loss of this trade is that $3.75. Now, another way to put this is we're spending $3.75 net, and we obviously don't know and $0.75 per share to set up a scenario where if these contracts are ultimately exercised and assigned, we'll turn that $3.75 into $5. Here's what I'm talking about. We have the right to sell shares through the 16th of May for 190. Someone else has the right to sell shares to us for 185. That's the deal that we're paying $3.75 to get into. The objective here is for exactly that to happen. If both of these contracts are in the money at expiration, well, the short option is assigned at 185. We buy the shares at 185. We sell the shares at 190. That's a $5 value out of a $3.75 investment. So that would leave us with a theoretical maximum gain of $1.25. And you'll notice, yep, the reward potential is higher than the risk potential. That's due to the probabilities of the trade. What's the likelihood of success on this trade? Well, we can use delta as a possible gauge. Really, we're just hoping that the stock is below this vertical spread at expiration. We'd like to be below 185. That puts both of these contracts in the money. And our delta can actually be a gauge for the likelihood of the contracts expiring in the money. Now, delta also can tell us the degree of leverage on the trade, how much we might make or how much we might lose as the stock price moves up and down. But a delta of 68 or 69 is telling us there's about a 68, 69% chance that both contracts are in the money and we realize the maximum theoretical gain. So high probability of success. There is a lower probability of failure. Only there's a 76% chance that the stock is below 190, or in other words, a 24% chance that the stock is above 190, both the contracts expire worthless. Yep, and we lose the 375. But I want to go ahead and place this trade. Let's go to the spread. Let's change that to vertical, and that's going to pair up the contracts with each other. And I can go to that 190, 185 put spread and click on that ask price to create a long vertical spread. And it looks like mid is 353, natural is 390. Let's say we are willing to pay the 375 that we've been discussing. That would be a $375 maximum theoretical loss per contract. In this webcast series, we typically risk about $4,000. That would be close to 11 contracts. There we go. So let's click confirm and send. See if we can get this filled. Seeking to buy 11 of these verticals, the 190, 185 puts, 375 limit. That would be a $4,000-ish loss potential, a $1,400-ish profit potential. There are commissions to be paid here. So let's send that order off. And we bought it for 370. Okay, we were thinking it was going to be 375. Cost us a little bit less. That leaves a little bit more meat on the bone for potential reward. But guys, we have accomplished what we set out to do today. What I really wanted to learn was this lesson of, I don't know, do we want to call it overconfidence or maybe heightened fear, depending on the trader's perspective? Ooh, this thing is definitely going to get assigned for better or for worse. Maybe not. If we choose to stay with options, the unexpected can happen at any moment, including the last day or two right before expiration. So interesting discussion. We've learned from our current positions. We've looked at the markets. We've placed a new trade. We'll see how this trade pans out. We'll talk about its management along the way. So I do hope you'll put it in your calendar to join me each week to continue to learn from these strategies. But everybody, time for me to let you go. Thanks for joining me today. Thanks for giving me your time today. A couple of reminders. Number one is if you haven't subscribed to our Trader Talks channel, make sure that you do that. Go down right below the video stream. You can click on that subscribe button if you haven't done that already. It literally only takes a second and it doesn't cost anything, but the Trader Talks YouTube channel is where we house our previous webcasts. The vast majority of our webcasts they're recorded and then archived to our Trader Talks channel, and you can find those according to playlist right here. So, for example, I have a playlist for this webcast series for long verticals and diagonals. You can click on playlists and you can see the different series titles as you scroll down through. So you just look for the one that you have an interest in. You have my advanced charting techniques right here, or trading the trend with James Boyd, or whatever your particular topic of interest is. Of course, you can also join our live streams here on the channel. Now, another thing that I would suggest is that you follow us on X. You can see my X handle down there at the bottom of the video stream. It's at Cameron May CS. You can also follow Connie at Connie Hill CS. But that's the best place to connect with your favorite presenters. If you have an account with X, just give us a follow. It's also where you can just get our more current thoughts on things that are developing in between the webcasts. But everybody, thanks for joining me today. Thanks to everybody that's already given a thumbs up or a like on the webcast. I can see 39 already. Awesome. Thank you for doing that. That sounds like applause to me. It also gives my webcast a boost in the YouTube algorithm, helps more people find these things so they can learn from our discussions. But I'll see you in a future webcast. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.